I'd lived through the 1998 long-term capital management debacle. I'd lived through the tech wreck of the early 2000s, right? COVID. There's all sorts of crisis events that happen with long-only equities. So for me, I said, there's got to be a better way. And obviously, coming from the world of alternative strategies, I thought, well, you should have stocks, you should have bonds, but you should have this other instrument called alternatives. Let's make that the third leg of the stool. And that will give you the diversification needed to make it not only in bull markets, because you still have equities, but in bear markets when you don't have those opportunities in equities. That's when AlphaCore was kind of conceived, was let's marry the best of both worlds. Let's put together good wealth planning with high-level investment management. And that's what we do today.
Hey, everybody. Welcome back to the Connected Advisor podcast. I'm your host, Kyle Van Pelt, co-founder and CEO of Milemarker. And today I have Dick Pfister. Dick is the CEO and founder of AlphaCore. He is also a husband, father of three, and he is a transplant from Wisconsin to California, but he never lost his love for the Packers. He's still a raving cheesehead. So, Dick, welcome to the Connected Advisor. Thanks for taking time.
Thanks for having me, Kyle. Thanks for having me.
Absolutely, man. So I start this podcast off with the same question for every guest. This isn't going to be any different. So what I have found in hundreds of these conversations is that everybody has their own unique path to this industry. You know, unique can still be traditional, or it could be untraditional where you came in from left field or the side door. But what I've found is whether your path is traditional or untraditional, everybody has what I refer to as a money moment in their life. It was something that happened in your life, a circumstance, a situation where a light bulb went off and you said, hey, that's it. This is what I want to do. I want to spend my career and my time helping people with their money, working in this space and going this way. So, Dick, for you, what was that money moment?
That's a pretty funny story, Kyle. So it goes back quite a few years. We talked in the opening here. I grew up in northern Wisconsin, actually north of Green Bay. So very, very north on the border of upper Michigan and Wisconsin. And my father was a dentist and an orthodontist. So not in the finance industry, but more on the medical side of things. But in the late 60s, early 70s, that was when inflation was extremely high. It kind of resembles, in a way, 2023 and 4. But back then, when you were a dentist, you were putting fillings in. You would put in silver and gold fillings. Now they're more porcelain, but back then that's what kind of was the go-to thing to do. And I was around 7 or 8 years old when I decided that I was going to paint some stripes on my bedroom wall without telling my parents, by the way. So I was going to paint some stripes on my wall, and I was going to paint green and gold stripes for the Packers with like a lightning bolt kind of look to it. So I went into our garage, and underneath the workbench, there were paint cans, and we had 2 rows of paint cans. So I went into there and I pulled out a paint can from the back row. And when I opened it up, there were some coins in it. So I didn't know what that was. So I kind of put that one away, still looking for paint. I went to the next one and there were more coins in it. And so I took those paint cans inside to my mom and I said, Mom, what are these gold coins and silver coins? You know, tell me what you're doing these for. Well, just put those away. Those are Daddy's coins. And you'll find out someday what they're for. And by the way, what are you doing painting your wall? You're not allowed to paint your wall. So when I got a little older, I found out that my mother's brother, my uncle, who's in the industry, his name is Tom DeMark. He's a pretty famous systematic trader, has been working in the alternatives business for many years. He had called my dad up and said, hey, if you're going to allocate, you know how to get gold and how to get gold Krugerrands. You should buy gold Krugerrands and buy silver dollars back in the late 60s, early 70s, because I think that we're going to be in an inflationary period for a while. And that's how I learned about it, got hooked on it. You know, kind of years later, after I got a business degree out of University of San Diego, I went down to the floor of the exchange in Chicago, the Chicago Mercantile Exchange, and really got my hands dirty on the world of futures, financial futures, commodity futures, and really came full circle. But it started at a very early age.
Wow, that's a cool money moment. That's pretty neat. So it turned out your dad was just hedging against inflation with these paint cans full of coins. Is that the idea?
Yeah, it was, this is northern Wisconsin in the 70s, right? So these were preppers before there were preppers. These are early days. And he did very well on those. For a dentist, he did pretty well. And, kind of reminded me of I didn't come at it from the traditional business school way. I came at it from the financial futures and commodity futures world. And then I started to learn more about the world of good risk management. And some of the best money managers when I was working in the 90s in Chicago, actually worked for a company called Dean Witter, or a lot of people probably remember, but eventually got bought by Morgan Stanley. But Dean Witter back in the day was the largest futures clearing firm in the world. And so the biggest and the best money managers just to clear their positions through Dean Witter. And so I got to meet some of these great money managers that weren't that famous back in the 90s, but today they're famous. They're names like Paul Tudor Jones, George Soros, Bruce Kovner, Julian Robertson. All those guys were trading through Dean Witter. And I really started to understand how they managed risk, how they were providing returns, whether we were in a bull market or a bear market. That is really how I got my start.
Yeah. Man, what a cool story. And a decent segue, because I think you have kind of this amazing history with people who were really great with alternative investments, even the guy giving your dad advice about, silver and gold, and then, watching what was happening at Dean Witter and all of that type of stuff. Mm-hmm. But then you came and I wouldn't call AlphaCore a traditional wealth management advisor, but, you didn't go the route of, hey, I'm just going to trade alts. It looked like you said, hey, there's a way to take what those people are doing and really bring that to people who are doing more traditional planning and things like that. I don't know if that's totally accurate from my notes, but is that kind of what the impetus for AlphaCore was retail wealth management can do alternatives a lot better, and I'm going to go help them do that?
Yeah, great question. So AlphaCore today we've been around for about 9 years, and we oversee about $3 billion of client assets. And we do full wealth advisory, wealth management, and that includes things like financial planning, wealth planning, but we marry that with intelligent investment allocation. And the reason we got to this point is because my predecessor firm was a firm by the name of Altegris. And Altegris was launched in 2002, so quite a while ago. Altegris was built to provide access to best-of-breed alternative strategies, basically democratizing so that an individual or retail investor could get into some of these big managers. If you tried to go directly to some of those managers, their minimums were $10 or $20 million. And so they were relegated to the pensions and endowments and large institutional investors. And we always felt like the people that need those type of return streams the most were the individuals. So why don't we create vehicles to allow access? And so most of my career has been about democratizing access to good money managers. And in 2013, we ended up selling my previous firm. And at that time, I had a personal liquidity moment, and I was still working full time. But so I went and sat with about 3 different local investment advisors in San Diego with my wife, and we sat down. We said, okay, we've got this amount of money. We've got 3 children. What do you think we should do? And generally speaking, most of those advisors were very good at gathering data and doing what I call financial planning 101, right? What's your assets? What are your expenses? Do you have a trust? When do you want to retire? Do you have money for 529 plans? And they're very good at those things. And then when they're done with that, they say, okay, your goals and objectives are these, and your return that you should try and hit is, let's say, 7 to 10%, right? And generally speaking, most financial planning tools will have that kind of high single digit, low double digit. And if you have enough money, you can outlive your money, right? Well, when they went to implement the strategy, the asset allocation strategy to reach those returns, I just felt the asset allocation strategy was outdated and, quite honestly, a little bit too risky for me. Because their answer always was, well, let's put 60% of your money in long-only stocks and 40% of your money in fixed income. And, I lived through the 1998 long-term capital management debacle. I'd lived through the tech wreck of the early 2000s, the '08 crisis, right? COVID. I mean, there's all sorts of crisis events that happen with long-only equities. Every 5 to 7 years, you have a 30 to 50% pullback. And at the time in 2013, 14, interest rates were essentially zero, about 1%. So if rates were to rise, I'd lose money on the fixed income side. So for me, I said, there's got to be a better way. And obviously, coming from the world of alternative strategies, I thought, well, you should have stocks, you should have bonds, but you should have this other instrument called alternatives. Let's make that the third leg of the stool. And that will give you the diversification needed to make it not only in bull markets, because you still have equities, but in bear markets when you don't have those opportunities in equities. That's where an AlphaCore was kind of conceived, was let's marry the best of both worlds. Let's put together good wealth planning with high-level investment management, and that's what we do today.
That's awesome. I really like that. I think alts have a huge place in a lot of people's portfolios. And I've been starting to hear that people are looking to up, maybe even target allocations of what alts should be in portfolios. But I also think, alts or alternative investments is a really broad statement for a lot of different vehicles, right? You've got certain real estate vehicles that are supposed to maybe manage risk. You've got your high growth unicorn, venture capital, private equity style investing, which is also an alternatives. You've got private credit. You've got all these different types of things. So when you look at this huge universe of alt options, is that purely we're going to look at the wealth planning side and say, hey, Kyle needs this type of allocation or Dick needs this type of allocation or whatever it is. And then you go to that universe and filter it down? Or do you like to use certain vehicles, in all situations based on the asset allocation?
Good question. And it's not an easy, simple answer, but each client essentially has different goals and objectives, right? Some of them might be looking to retire at a certain age. Some might need a certain amount of income produced off their portfolio. Others might say, well, I've got a chunk of liquidity that I need, but other parts of it I don't need for 10 years. So they can handle some illiquidity. For us, it's about marrying those two together, the goals and objectives with the correct asset allocation. And if you look at the world of alternatives, you mentioned a few of them, we really have to define what we mean by alternatives, right? So we bucket it into two large categories. One would be alternative asset classes, and that would be private equity, private real estate, private credit, venture capital. Those are essentially long-only asset classes, but in an illiquid wrapper. Whether that's quarterly or annually or even longer, that's a long-only asset class. And in a lot of times you get great illiquidity premiums, so a premium of return over and above what you would get in, let's say, the public markets. But that's alternative asset classes. And then in the alternative strategies bucket, those are the things that are trying to make money in and year out. And they're more hedging in nature. And those are the things like long-short equity, trend following, global macro trading, multi-strategy. Those are arbitrage and hedge strategies that typically can provide return when the market has a pullback, or they can provide what we call crisis alpha. So like in 2022, when stocks and bonds are both down, some of those strategies were actually up quite a bit in 2022, or in COVID and those types of events. So when we put together our portfolio, we're matching liquidity, income, and time frame across all of those types of asset classes. And it's my belief that eventually we won't even call these alternatives. We'll just say there's liquid instruments, there's illiquid instruments, there's correlated instruments, and there's non-correlated instruments. That's the four options.
That's insightful. I really like that comment at the end because that does make sense. Because I think that's really what everybody is trying to target is, how much liquidity do you need right now? How much of this can be tied up because you're not worried about this for 30 years, 10 years, whatever it is. Right. So, okay, that's cool. So you mentioned that you started the firm in 2015 and there was zero assets when you started that. You guys, as you stated, you're coming up or you're a little over 3 billion in AUM now. From what I understand, first couple of the years were focused entirely on organic growth. But a lot of people, especially during past 10 years, bull market and everything, kind of had atrophied on what organic growth looked like. I don't want to say we were resting on our laurels, but everybody was kind of riding the tailwind of largest bull market of, maybe ever. So what was it about that you were so focused on organic growth and how you were having so much success to grow so quickly?
Yeah, organic growth to me is the lifeblood of a well-run wealth advisor. That means what's happening is you have clients that are telling their friends, that are giving you referrals, that are telling their centers of influence, whether that's attorneys or CPAs, and their CPAs are referring back to you. You're offering a good or a service that people actually want. And if you have that, you know what you're offering is in need or in demand. So for us, that's always been at the center of our growth. And I actually wrote down 7 AlphaCore values about 6 years ago. And just to make sure that the team that we're putting together follows these core values. But the number one value is do what's right for the client. And when you do what's right for the client, whether that's, even if it's more expensive for you as a wealth advisor to do, or it's more difficult, it's operationally inefficient, you're going to get good organic growth because you're putting their interests first, right? And then the team that we've brought on, the other 6 values are basically how we treat each other. So operate from a win-win solution mindset and check your ego at the door, have fun along the way. And the people that we brought on all have that mental attitude. They themselves, whether they're advisors or they're in business development or they're in compliance or operations or client service or research, they basically espouse the AlphaCore story too. And so that helps with organic growth. And for us, that's a matter of finding the right people to bring on the team. So we've done a couple of things in the last 2 years where we've done 2 acquisitions and mergers. And mainly, they found us, we didn't find them. And that was because of our growth and our story and our philosophy and culture. And that's how we approach inorganic, is that we're looking for people with the same culture, the same ethics, and the same philosophy. And if they're on that same page with us, they're good fits with us. And we feel like we're bringing in high quality, diversified talent. And that's been an interesting area for us as well in the last few years.
This podcast is brought to you by Turncast. We make game-changing content for fintech and financial services companies. Learn more at turncast.com.
So you said a couple things there I want to double click on a little bit. So one, it was in passing, but you talked about whether or not they're in business development. And I actually feel like this is a pretty two-sided topic in our industry, is whether or not you should have people who are specifically focused on business development for the firm, or if that should just be a role of people who are serving those clients and things along those lines. So it sounds like you've opted for having team members who are specifically focused on business development. Talk to me a little bit about that decision and how you've been able to make it successful.
So we've done a couple of things in the last 2 years where we've done 2 acquisitions and mergers. And mainly, they found us, we didn't find them. And that was because of our growth and our story and our philosophy and culture. And that's how we approach inorganic, is that we're looking for people with the same culture, the same ethics, and the same philosophy. And if they're on that same page with us, they're good fits with us. And we feel like we're bringing in high quality, diversified talent. And that's been an interesting area for us as well in the last few years. It's interesting. I think that's an ever evolving world. But generally what I'd say, I've been in this business for 30 years, right? There are certain personalities that are naturally geared towards have an outgoing personality where you could sit down at a dinner and they'll tell you, all of a sudden, the person next to you starting to tell you their life story. And they have a natural component of their DNA that's good about opening up relationships. And then there's a certain personality that's much more detail-oriented, that loves to get into the weeds of somebody's, let's say, financial plan, and then do the ongoing quarterly updates. What we're trying to do is match personalities. So if we have somebody that's in business development, they might be incredibly personable, incredibly intelligent, but their day-to-day, their 8 or 10 hours a day, they want to spend doing that. And then say, okay, great, I've got a team behind me that's incredible at doing planning, incredible at doing your quarterly updates and managing your portfolio. So we're essentially just matching the personality with the appropriate household and client. So that's kind of the delineation, I would say, between quote unquote business development and the advisor. Now, there are sometimes where you have both in one person. It's somewhat of a unicorn, but they're out there. And sometimes you have the advisor who likes to do both sides of that. Now, they get to a certain stage where they run out of daily capacity. So they're going to need junior advisors, planners around them. We have a few of those on our team too.
Awesome. Mm-hmm. So then the other thing was, you talked about how you weren't really planning on M&A or acquiring firms, but a couple of these firms came to you more than anything else. You weren't out there hunting them. You weren't actively deploying a strategy of consolidation. Was that always part of the business plan, though? Was, hey, at some point we want to go ahead and start rolling up firms? Or did these opportunities come to you and that made you go, you know what, maybe we should take a look at this?
A little bit of both. I think there was always this idea that eventually we would be in the merger kind of space or acquisition space. But we didn't want to do those types of acquisitions just for acquisition's sake. We wanted them to be accretive to us, but also like-minded. And so the first 2 that we did over the last couple of years, they did find us through other industry connections and turned out to be incredible additions to our team and in geographies that we already had clients, but didn't have any boots on the ground. So we have a Denver presence now that's growing. We've got a Greenwich, Connecticut presence that's growing as well. And those have been great. So then once those have happened for us, we said, okay, now how do we put more strategic effort into this. And so I actually brought on a head of corporate development about 4 months ago who is specifically looking for the geographies that we'd like to be in, but like-minded people. And that's how we're going to do that acquisition mentality for us, is more of a talent acquisition and then bolstering that hub, if you will, in those different geographies so that we can get more exposure.
That's awesome. And I'm curious to think about or ask you about this, because I think about this on a regular basis with all of the acquisitions going on. I get the privilege of talking to folks like yourself quite a bit, and it's clear that you thought a lot about the core values and the culture of AlphaCore. It's what you said kind of helped you grow, from 0 to 3 billion in a relatively short time frame, all of that. When you think about acquiring another firm, right, you're kind of putting at risk, and you talked about risk management with portfolios, right? How did you think about the risk management for your culture and for the core values and for things like that when you're kind of implanting an entire different culture and team and everything like that? I know everybody's like, hey, we want it to be as much of a match as we can, but it's always going to be different. So curious to hear how you navigated those waters.
Well, it becomes a natural filtering mechanism, right? Because not every shop that's looking to merge or be acquired is a candidate. Be specifically because of that reason, right? Culture and philosophy. I think a lot of people will say this. It is paramount, and it really truly is. It's there are so many 50 private equity firms now invested in the wealth management space. So the money is there, right? That's not been the issue, and it hasn't been for call it the last 5 to 10 years. Doesn't look like it's going to be the issue for many years to come. So it's not really the money, and I think that the sellers or the potential acquirees understand that too. At least the ones that are more thoughtful about it. They understand that they can be a little bit more patient with who they agree to merge with, and I think that's critical. I think it's actually a good thing for the industry. They don't have to rush to go pick the acquirer. And for us, that's helpful too, because we don't have to rush into a process and put in a bid and make sure that we get out there and be the highest multiple. We're looking for the shops that actually think that the price we would potentially pay is not only fair, it's enhanced by what we're going to bring to them from the years go forward, right? Not just a succession plan, which is obviously something that we do, but it's also the growth for their generation 2 for years 1 through 5 through 10 after, and it becomes a natural filtering mechanism, right? Because not every shop that's looking to merge or be acquired is a candidate. Be specifically because of that reason, right? Culture and philosophy. I think a lot of people will say this. It is paramount, and it really truly is. There are so many. I think there's over 50 private equity firms now invested in the wealth management space. So the money is there, right? That's not been the issue, and it hasn't been for call it the last 5 to 10 years. Doesn't look like it's going to be the issue for many years to come. So it's not really the money, and I think that the sellers or the potential acquirees understand that too. At least the ones that are more thoughtful about it. They understand that they can be a little bit more patient with who they agree to merge with, and I think that's critical. I think it's actually a good thing for the industry. They don't have to rush to go pick the acquirer. And for us, that's helpful too, because it gives us we don't have to rush into a process and put in a bid and make sure that we get out there and be the highest multiple. We're looking for the shops that actually think that the price we would potentially pay is not only fair, it's enhanced by what we're going to bring to them from the years go forward, right? Not just a succession plan, which is obviously something that we do, but it's also the growth for their generation 2 for years 1 through 5 through 10 after. And I think that's how we're finding great fits for us.
Yeah, that's well stated. So Milemarker is a technology company. I'd be remiss if I didn't ask you a little bit about this, but as you're looking at growth, as you're integrating other firms and stuff, where are you kind of seeing some potential challenges on the technology side for your scaling and your growing, right? I mean, there's so many great pieces of technology that help you serve households, that help you do all that work. But when you start trying to install other firms and you start getting bigger, when you start scaling, I think things start to inherently break. And I'm curious, from the seat that you're sitting in, what are you thinking about right now in those weekly meetings about technology and the role it's going to play for AlphaCore?
Right. Good question. I think to scale and provide still the high level of customer service that we are very keen on making sure we do, you've got to use technology. And I think firms that are in this growth phase that get to, let's call it maybe 10 people on staff, between 10 and 20, they run into that hurdle or kind of glass ceiling of operational efficiency or scale. And if they don't embrace technology, invest back into great technological solutions, they are going to miss out. They're going to essentially hire bodies where they could use technology, and that necessarily is a short-term fix, not a long-term fix. So from day one of AlphaCore, we have taken most of our P&L and invested back into technology and staff. Right,
Oh,
that's
wow.
been a critical thing for helping us scale. So we invest in our CRM is Salesforce. It is, as anybody who uses Salesforce or understands Salesforce, you cannot use Salesforce just out of the box, right? You've got to have some experts to understand how to program, build reports, build dashboards, build workflows, and it's got to be specific to your practice and how you run it. So we spent years on building that out on our side, and really has built efficiencies in for the advisor in their practice and in the clients, and moreover, just the overall well-being of our staff, because it's not antiquated. It's a few clicks of the button, and having team members on the staff that understand it well really makes their life easier. And you could do that across all solutions, whether that's planning, whether that's client reporting, trading and rebalancing. You've got to take that mentality for every one of those.
Yeah. I love that. I love your comment about anybody who's used it knows. We affectionately refer to Salesforce around here as the Ferrari from IKEA. Tons of power, but some installation required, right?
Very much.
Yeah, that's great. All right, so that does lead into one of my favorite segments of the show. So I'd love for you to get out your crystal ball and just talk about what are some of the macro trends that you see happening in the industry. You can take this approach from alternative investments as a whole. I know you earlier on alluded to hey, we're probably just going to start calling these liquid illiquids, correlated, non-correlated. But what are some trends you see coming down the pipe? What are some things that you're looking at and trying to angle AlphaCore to be prepared for? And just what do you think the future of the industry looks like?
Yeah, I mean, I definitely would say that alternatives are going to be mainstream. They're obviously much more mainstream today than they were a decade ago or 2 decades ago. It's been more and more prevalent. We have an edge or an expertise in alternatives, unlike most other advisors, given our DNA and where we come from. But if you look 5 years from now, that's going to be table stakes to get into the game, right? Just to make sure you understand the world of alternatives. And you've got some great players out there now that have caught up and are implementing, which I think is good for the end client. The wrappers or the vehicles to get in are becoming more mainstream, easier to get into, more liquid. The subscription process is much more simple. And you've got the platforms like iCapital who have really helped catalyze that. So that's been great to witness and be a part of. On the other side, I would say you kind of have to make sure you're embracing artificial intelligence in a way that you can utilize to help scale and be more efficient. I think that's going to become more and more a part of what we do, not to replace, but to enhance what we do. And I think you could say that about almost every industry with AI, but in the wealth advisory space in particular, there are some applications where I could see it really helping. And if you think about research, if you think about client recordings and making sure that you actually follow up on time, all sorts of efficiencies that AI will help us with. And at the end of the day, again, making sure that the end client experience is better. I think that's going to be a big move and evolution of the industry.
Yeah. Okay. Thank you for sharing on that front. So speaking of the future and us talking about alts, I mean, this is something that I find myself just personally curious about. But I mean, where do you think we are in terms of alternative adoption? Do you think it's still relatively early, or do you think we're kind of in the middle game? And, some context around that question is, I think you're right that iCapital and Case and some of these platforms have provided incredible access to a bunch of things. But I also think in some cases, the best alpha out there for alts is the 3 partners who are really good at hotels in Columbus, Ohio or something. And, that's just not going to show up on an iCapital. And, so I feel like it's still just such a fractured or fragmented universe and things like that for trying to make it easy for you to be able to get your clients access to all these things. And so I'm curious just about where you see the adoption curve or the level of maturity for alternatives, for investors in the retail wealth management space to adopt it.
Yeah, I think we're still in early innings. I think alternatives, it's about education and access, right? So for many years, there's been firms, including my previous firm, that's been trying to solve the riddle of access and making that more efficient. And obviously the likes of an iCapital have really taken that to the next level and make it streamlined, and using things like DocuSign and reporting. That's the access and operational efficiency part. The educational part, to me, should go hand in hand, because firms are doing better and better at that. But the advisor themselves has to be educated so that they can explain it to their client. And because it's just like anything else, I think the education around, let's call it long-only stocks, has been drummed in everybody's head that you don't get out. Even if the market's down 30 or 50, hold for the long run, hold for the long run. Well, every strategy is going to have their good periods of time and their bad periods of time. And so when those bad periods of time come around, let's say for private real estate or for private equity or for venture capital, you need to have the same level of confidence as an advisor when you're talking to your client about why it was put into the portfolio to begin with and why they should be holding or not. Yeah. Those are the pieces that I think are still growing and evolving. That educational piece. Now, Kaya, Chartered Alternative Investment Analyst, that's done a very good job of spreading the word, but it's still, it's not at the level of a CFA, right? I think we have, 20,000 members of Kaya now, which is phenomenal, but it's still early days. If you think about the next 10 years, most advisors that are in the space, or at least team members on their group, will have to have that level of expertise.
Awesome answer. All right, we're going to move into the final segment of the show, what we call the Milemarker Minute. So it's a series of lightning round questions. The goal is to try and have all of the questions answered in a minute or less, but we won't hold you to it if we don't keep exactly to that. A little bit more lighthearted, trying to learn more about you outside of the industry as a whole. So you ready for the Milemarker Minute?
Okay. I've not received these questions in advance, so.
That's the whole point. Nice and surprising, okay. Right? All right. First question for you. If you could travel anywhere in the world that you've never been to before, where would you go?
Egypt.
Oh, okay. That's a good one. That's different. What is the best book that you have read in the past year?
I read this book every year, The Obstacle is the Way by Ryan Holiday.
Ryan Holiday, good choice. Yes, very good. If you were to do another career besides wealth management, so I love my money moment question, but let's say, hey, different path, different alternate universe, you're in a different career, what do you think it would be?
I don't think this is too unique, but there are drums behind you. Talked a little bit about this. So I was in a band in high school. I love that space. And I don't know if I actually liked all the stuff that goes with being a rock star, but I would have loved to do that.
Yeah, musician would be a ton of fun, right? That's awesome. Okay. Prediction. It is late September, football. We're 3-4 weeks in. What do you think the Packers record, or how do you think their season ends this year?
I think they go deep. I think Jordan Love getting hurt was actually a benefit, not a detriment, because it got the rest of the team involved. We've seen what Malik Willis can do. It really brought the other team members up. So they're going to use this as a catalyst to become even a better football team. So hopefully they've got a good kicker this year that doesn't keep them out of the Super Bowl. So hopefully they're deep in the playoffs at least.
I love it. All right. Last question. You're almost done. You're almost out of it. Everybody knows the weather of Southern California is one of the biggest draws. So besides the weather, what is the best part about living in Southern California?
Being able to watch my kids' sports year round, playing golf with my son year round, basically being able to be outside with my family, regardless of the season.
Yeah. Well stated, man. All right. You made it through the Milemarker Minute. That was a great job. And that is the final segment of the show. Thank you so much for dropping some incredible insights about alternative investments, how we are combining them with the retail wealth management side of things, how you've grown AlphaCore, which is just an awesome story. Congratulations to you on what you've done there and all of the work that you're doing to help educate the world around alts and a host of other things. I really enjoyed the conversation. I appreciate you coming on.
Thanks for having me, Kyle. I appreciate it.
Absolutely. All right, everybody. That's been another episode of The Connected Advisor. Please make sure you click follow or subscribe wherever it is that you are consuming this so that we can make sure that you get notified of the next great conversation like the one with Dick. Also, if you'd be kind enough, please leave a review for us as it helps more people be able to see or hear the conversations like we're having here today. But until the next time you tune in, enjoy every mile.